Do have a question for you though, Charlie.
Lay down.
Biggest lesson that you took away from the year?
Anything can happen.
That's a good one.
Yeah, I would have to say, and I'll put some bounds around this, the thing that I caught myself on the most was I was making too many assumptions and treating them as facts, right? So I was like, well, interest rate, and this is just an example, interest rates won't go up. So that's an assumption. Like that's me actually having an opinion on the environment and then having risk in the market based on that. Where it's like, turns out they can go up. And the one that I would say, and I don't necessarily love talking about this topic, but it's like I never thought that a potential conflict between countries could break out. I kind of thought we were past that as a society. And when I reflected, I was like, well, that was pretty ignorant. Like there's continual tensions. And then the land tax thing, to think that governments can't make changes to policies and taxes. So there's so many areas where I had blind spots and just was like assuming those things wouldn't change and putting investments at risk against that blindly. So I really look at this and go, having a more open-mindedness to you just don't know what can happen and adjusting risk accordingly, absolutely my biggest lesson of the year when it comes to investing.
Things can change. What is it? The only thing in life that's constant is change. It's like, hey, it's not always going to be the same. It was interesting. The way that I think about mine as my biggest lesson was, have you ever looked at, I don't know, maybe car insurance, right? And like every year, you're like, cool, my parents told me to go get car insurance and it's the right thing to do is insure my car. And then over 10 years, you're like, man, I never use this car insurance. I've spent a fortune on this car insurance. And then you run into someone and you're like, whoo, thank gosh I had car insurance. And it revalidated why you had this risk mitigation in play. That was it for me, was the revalidation on an idea and a concept that a lot of people have been challenging and trying to challenge me on, which is conservativeness. And I know that, Charlie, you're more like risk adverse and conservative than I am, especially with your size portfolio. Me looking at going back at this year and saying, holy smokes, am I ecstatic that I was putting minimum 20% deposit down on every house. I had insurance on it. I had emergency buffers, not just personally, but in every single property, because this massive impact that's happened everyone has received, or most people have received, like, we've just skipped it. Like it just hasn't impacted me, because I'm like, I look at it as now these things will exist in our portfolio for a very long period of time and actually be able to compound over the next 20, 30, 40, 50 years, as opposed to me risking having a look going, what am I going to sell? What do I need to offset? How do I take something from the business to go and put into it? So for me, the biggest lesson it was not so much a lesson, it was just a revalidation is what I called it, of just saying, hey, like this risk mitigation thing and emergency buffer thing, like everybody's sitting there going, lever up, get more debt, inflate away debt, do all these things. And I'm like, resisted it. I'm like, Grant, you're doing the right thing. And that was the right plan. And into the future for the next couple of decades, I think I'll remember this situation to validate all of my risk mitigation and the large deposits and the emergency funds and everything, because it's like, you just don't know what's going to happen.
I will admit I have been a little bit smug this year. I copped some flack about our episode and how much cash reserves I keep and like how well buffered I am. But I've been sticking my nose up at people continually across the year because of it. No, not at all. But don't you find that you have a different appreciation for those people that don't get greedy in the boom times? You look at it and go, oh, you're actually the sage.
That complete. It's fun. All of the stories that I read about, it's like the person that didn't wipe out is the one that wins. And the person that you read about in the newspaper that's like had this massive win that you never hear about again are the ones that wiped out later because they just took too much risk. They had a massive win and then they lost. And you just, okay, that's not how you should play this game.
The thought did cross my mind at the start of the year, and maybe a little bit before that, is like, why are we slowing down with property? Like we should go way harder. We should do another 10 across this year. And I look at what it would have happened if we did that. And I go, wow, like that would have potentially been a wipe out of it. Maybe not, but it's like I look at it and go, I appreciate risk very, very differently. And you can imagine and I'll bet there's some people out there today hurting because they're over levered or were too bullish. And it's like the sustainability game is the one to play. Like you don't want to, the risk of wipeout events is just too high for people. All right, well, moving on. Last question on this for our panel. And I've enjoyed this back and forth, Grant. I think this is really interesting to unpack some of the reflections of the year. Would you do anything differently?
Yes. Dude, hindsight is a killer.
Wait. You actually answered the question. You didn't stall. Straight out of the gates.
I was like punching myself under the table, just going, just answer the question. Damn it. Totally. There are two things which I find comical now, right? And they should be comical because, again, like I can't change anything and it is what it is. Two things that I would have done differently. One, I would have sold my crypto at the start of the year.
Nice.
Which I'm fine with it. Like,
do we have to do a podcast episode? Is crypto now dead? Like, is this over? Anyway, we'll come back to that at another point.
So that was one. But again, like I'm not trying to defend my position, but I'm like, I'm for it. It's completely speculative. Like whatever happens, happens. Like no worries at all. Like it would be more my greed saying like I needed to sell this thing than anything else. And the second one, which is like, imagine I had this magic wand, Charlie, of like, ooh, and that is going to be the second that a high inflation print's going to come out. At the start of the year, I would have gone hard for like 3, 4, 5 months and just bought as much property as possible and just let that thing ride. And I'm talking like probably Q1 I would have gone hard. And it's more because of the borrowing capacity. And I think that and it sounds like you're in a very similar position. Like the properties that we've got are in positions that have actually done, like in suburbs, I should say, that have actually done quite well, notwithstanding like what's happened recently. And I'm like, oh, okay, cool. Like if I had have just levered up and then just focused in on the business on the other side, I actually think that would have been a decent play. Now, would I have bought the 4 within like 3 months? No, I'm more saying I probably would have preferred to buy one more right back at the start of the year. Hey, fellow business owner, if this topic and value-packed short video has resonated with you at all and you want to dive deeper into creating wealth inside and outside your business, check out the full episode by clicking the link on your screen or in the description right now.